Whoa, what up, YouTube? This Steven. You watching Steven's channel, and today I wanted to speak about the tariffs that Trump's trying to pass. I was basically reading an article that I ran across that I wanted to share with y'all in case y'all wanted to learn what the tariffs are about, how they could affect the economy, how they could affect you. And just wanted to stay on top of what's going on in our political climate. So I'm gonna be reading through this article this evening. It's called "What is the Dow?" or Treasury Bonds. Are we in a recession? A simple guide to how Trump's tariffs are affecting the stock market. So the article was written by Andrew Romano. This was on Yahoo News. I'll leave a link in the description if you want to check this article out for yourself. If you don't want to hear me reading through it. Uh, it's wild swings on Wall Street reflect worries about the president's push to tax U.S. imports and relief after his 90-day pause. So let's look at the key takeaways. President Trump announced new tariffs on imports, causing the stock market to plummet amid fears of economic disruption and inflation. Trump's threats to raise tariffs on China by 50% and conflicting reports on negotiations with Japan and South Korea further roiled the markets, leading to a wild swing in trading. The stock market's response to Trump's tariffs reflects investors' expectations of serious economic pain for American consumers and businesses in the near term, with certain sectors suffering significant losses. Get a little sip of some lemonade right quick. So that's the key takeaways from this article. That's basically what we're going to talk about today. If you don't want to sit through this whole video, and you want to go through the article yourself, the link is in the description. So, all right, let's go. Last week, President Trump finally announced his long-awaited Liberation Day tariff plan, a new 10% minimum tax on all goods entering the United States from overseas, plus much larger than expected reciprocal levies on imports from major trading partners such as China, 34%, Japan, 24%, and the European Union, 20%. The stock market plummeted in response, reflecting global fears that Trump's new taxes on U.S. imports could disrupt supply chains, supercharge inflation, and trigger a severe economic turndown. On Monday, a series of new shockwaves. Trump threatened to raise tariffs on China by another 50%. A report that the president was considering a 90-day pause on his tariff rollout further roiled the markets, which swung wildly throughout the day before falling again late Tuesday and early Wednesday. On Wednesday afternoon, Trump confirmed a 90-day pause on most of his reciprocal tariffs, and markets soared in response. What's the connection between Trump's tariffs and the stock market? And how do bonds, 401ks, and mortgage rates factor in? Here's a quick explainer with key terms in bold. So, so far, it's looking like the market is watching every word that Trump is saying, And whenever he threatens to raise tariffs on imports, that cause the market to go down. And the tariffs are going to be on imports. That's going to be on companies in the country that's ordering stuff from outside the country. So that's imports. If you're ordering things from like China, there's going to be an import tariff on it. And what that does is cause the business people who charge the customers for the products to raise the prices to absorb the losses that they're gonna take on their end by raising the prices on all the imports. So that's pretty much what they're saying right now. So next, in the next section, I already read the article already, but I'm just reading it again. I'm going through it with y'all. Just want to take y'all with me because I'm trying to learn what's going on myself. So it's basically going to go through and break down the stock market. It's going to break down the bond market and, just how all of this finance stuff works. So let's get into it. What is the stock market? Stocks are units of ownership that certain companies allow the public to purchase. Why? To raise money and grow their business. Each individual unit is called a share. The people who buy those shares are investors. When you buy stock in a company, you actually become a part owner of that company. The hope is that if the business does well, the value of the stock will rise, enabling you someday to sell your shares for more than you paid. A stock exchange is where investors buy and sell, i.e., trade stocks. These exchanges can be physical places that also handle electronic trading, like the New York Stock Exchange, which is located on Wall Street in Manhattan, or they can be all electronic like the NASDAQ. So, kind of grab this article and Google all of these things if you want to know about each of these individual things like Wall Street, NASDAQ, New York Stock Exchange, things like that. So let's continue. Each exchange has its own listing of stocks. Those stocks aren't available for trading elsewhere. Other big stock exchanges include the Tokyo Stock Exchange, the London Stock Exchange, and the Hong Kong Stock Exchange. The stock market is the sum of these stock exchanges. A big picture way to describe all the buying and selling that's going on. So the buying and selling that's going on within all of these markets, that I just read through as the stock market. The market part is where buyers and sellers meet and come to agreements. So a stock index, meanwhile, is a way to measure how the stock market is performing at any given moment and to compare it to the past. Each index tracks a certain collection of telling stocks, hundreds or even thousands of them, and computes their overall value into a single number that serves as a scorecard for the market as a whole. The Standard & Poor's 500, aka the S&P 500, is a stock index that tracks the 500 leading companies listed on American stock exchanges, including Apple, Microsoft, Amazon, Meta, Berkshire Hathaway, and JP Morgan Chase. Is considered the benchmark measure of how the U.S. market is performing. The other two major U.S. stock exchange indexes are the Dow Jones Industrial Average and the NASDAQ Composite. The Dow is relatively small, just 30 prominent companies, making it less volatile. The Nasdaq Composite includes nearly all the companies listed on the Nasdaq exchange. Okay, now we get into the juicy part. What are tariffs? Tariffs are important taxes paid by the company doing the importing. Tariffs are important taxes paid by the company doing the importing. Tariffs are important taxes paid by the company doing the importing, not by the foreign country or foreign business sending its goods to the U.S. Trump has long insisted that America is being ripped off by foreign countries and that universal tariffs will level the proverbial playing field by incentivizing companies to retain American workers and ramp up U.S. manufacturing, all while funneling trillions of dollars in new revenue to the federal government. He has also railed against trade deficits. How much more money we spend on another country's goods and services than we earn from selling it ours, and vowed that tariffs will balance them out. But nearly all economists disagree with Trump's take. They say imbalances between individual countries are more a reflection of the flow of trade than unfair practices, and that most importers simply pass the added cost of tariffs on to U.S. consumers by raising their prices rather than going out of their way to replace the effective goods with American made alternatives. Then other countries retaliate with tariffs of their own, risking a global trade war and a recession. Let me get a sip of little lemonade. According to the National Bureau of Economic Research, NBER, a recession is defined as a significant decline in economic activity that is spread across the economy lasting more than a few months. The NBER considers several factors when formally identifying a recession, including downturns, and employment, income, and consumer spending. But the biggest common denominator in past U.S. recessions has been 2 or more consecutive quarters of declining gross domestic product. The total value of goods and services, no, I'm sorry, the total value of all goods and services produced within a country's borders during a specific period of time. GDP is a key measure of how big an economy is and whether it's growing or shrinking. Why are Trump's tariffs having such a big effect on the stock market? To understand the connection between the stock market and Trump's tariffs, you need to understand how stock prices are determined. When a company first goes public, a move known as initial public offering or IPO, its stock price is set by an investment bank. From there, the price tends to fluctuate based on supply and demand. If more investors want to buy a stock, high demand, then sell it, low supply, the price tends to rise. Conservatively, if more investors want to sell a stock, high supply, than buy it, low demand, the price tends to fall. Every share of stock has an ask price, the lowest price a seller is willing to accept, and a bid price, the highest price a buyer is willing to pay. When a buyer and a seller agree on the transaction price, that becomes the new price of the stock. Supply and demand can rise and fall for various reasons. One reason is a company's individual performance, health, financial health, earnings, and future prospects all influence how valuable a particular business might seem. But current events can sway investors as well. Trump's global war is a massive event, a risky gambit meant to rewire America's relationship with the rest of the world. And so far, the market's response, how supply and demand for various stocks has shifted since Trump's announcement, how prices have moved on to various exchanges, how indexes like the S&P 500 have measured this movement, tells a clear story. Investors expect the president's actions to cause serious economic pain for American consumers and businesses, at least in the near term. Which stocks suffered the biggest losses? Data journalist Nate Silver wrote Friday. They're largely consumer staples from the lower middle brow on up, or cyclical prices like autos and air travel. Uh, that Americans consume more of when they think good times are ahead, pull back from when they're in the brace position preparing for a recession. By the same token, major US indexes rebounded slightly Tuesday as investors tried to figure out what to make of conflicting reports about Trump's willingness to negotiate. The hope being that he will cut deals and ease tariffs. Then those gains evaporated when the White House raised its rate on Chinese imports to 104%, and China hit back with its own 84% tax on US goods. In Wall Street slang, Tuesday's temporary uptick, followed by a continued decline, is known as a dead cat bounce. Stocks often briefly rebound in moments of great uncertainty. CNN's Allison Morrow explained. The idea is even a dead cat will bounce if it falls fast enough from a great enough height. It's also known as the sucker's rally because it's usually not based on anything substantive. Are we in a bear market now? A bear market is when a stock index ends a trading day early. Excuse me. A bear market is when a stock index ends a trading day 20% lower than its last peak, signaling a sustained downturn and pessimism among investors about the future of the economy. A bull market is the reverse, when a stock index closes 20% higher than its latest peak. On Friday, the S&P closed down 17% from its most recent high point, February 19th. A further decline of about 3% will put it in a bear market territory. Bear markets sometimes foreshadow recessions, but not always. The biggest immediate response is for people who need to sell their stocks ASAP and might have to settle for smaller payouts, like seniors who are planning to cash in their 401ks, i.e., the collection of investments they've been contributing to via their paycheck in order to save for retirement. What about other financial indicators like bonds and mortgage rates? Bonds are different than stocks. Like stocks, bonds are a way to raise money. But instead of ownership shares, they're more like IOUs. And even the government can issue them. When you buy a bond from the US Treasury, like aka Treasuries, you're effectively lending money to the US government, the issuer, for a set period of time. In return, the government promises to pay you back the amount it has borrowed plus interest and a fixed additional borrowing fee at a later date. Let me get another little sip of lemonade. All right, let's go. Because the U.S. government is typically seen as a reliable issuer, and the U.S. economy is typically seen as fundamentally strong, treasuries have typically served as the safest corner for investors to take cover during times of turmoil in the stock market, according to the New York Times. But instead of buying treasuries, investors started to sell them off Tuesday and Wednesday, a possible sign of declining confidence in the U.S. government and economy. Meanwhile, mortgage rates, the amount of interest banks charge when they lend you money to buy a home, dropped to their lowest level since October. Mortgage rates are connected to U.S. treasuries, and they tend to fall when the broader economy is suffering. And I think that's the end of the article. And that was pretty informative. So the real thing happened at the end. Like, you learned about the bonds, you learned about the stock indexes, you learned about the stock market, bear market, bull market, but it's really right here, the bonds. And it was really right here. When investors started to sell off the bonds, the treasuries right here. Trump must have had to say, hold up now. We're gonna wait on this tariff stuff. We're gonna have to put a little hold on this tariff stuff, man. Y'all starting to mess it all the way up. Because, the stock market was cool, but the bonds, which is like the backbone of like the American economy, pretty much like starting to get sold off. I think that got Trump attention. Cause without those bonds, I think America is in some serious trouble. If you know what I mean. Cause America is already in trillions of dollars of debt. So the question is, how are they gonna pay back all these bonds? There is no money. So I'm gonna leave this link in the description for y'all to check out this article yourself. I read the whole thing to you. So you can't say no other content creator giving it to you like that. I read the whole thing to you. This just so that we could all catch up to what's going on with these tariffs, so we can know what's going on out here. This is Steven. You're watching Steven's channel. Subscribe to the channel for future content. Give me a like and leave some comments below. What's your thoughts on these tariffs? Think this could help the economy? Think this could hurt the economy? I'm not really here to really debate with nobody. As a disclaimer, not on anyone's side, but I live in America. I'm trying to raise my family, and yeah, these kind of things affect us. So I'm interested to hear y'all thoughts. Once again, leave me a like. Subscribe to the channel for the future content, future videos. And I'm gonna talk to y'all in the next one. I'm gonna holler at y'all. Peace.